Investing in real estate offers incredible tax benefits. One of the most powerful is the ability to offset passive income with passive losses. This can significantly reduce your tax burden. Depreciation is another major advantage. It allows you to deduct a portion of the property's value each year, further lowering your tax liability. Passive losses come from real estate investments like rental properties and DSTs. These losses can offset other passive income you might have, like income from other partnerships. Depreciation, on the other hand, is a paper loss that reflects the wear and tear on the property over time. Both of these strategies can help you keep more of your hard-earned money. By strategically using passive losses and depreciation, you can create a real estate portfolio that generates cash flow while minimizing your tax liability. This allows you to reinvest more of your profits and accelerate your wealth-building journey. These tax benefits are a key reason why real estate is such an attractive investment for savvy investors. Leverage is a powerful tool that allows you to control more real estate assets than you could purchase outright. When you use leverage, you are essentially using borrowed money to increase your purchasing power. This allows you to acquire larger properties or multiple properties, which in turn can lead to significantly higher depreciation deductions. For example, let's say you have $1 million to invest. Without leverage, you could purchase a $1 million property. However, with leverage, you could potentially purchase a $4 million property with a 25% down payment. This means you now control an asset worth 4 times your initial investment. The increased depreciation deductions from a larger asset base can significantly offset your tax liability. However, it's important to remember that leverage is a double-edged sword. While it can amplify your returns, it can also amplify your losses. It's crucial to carefully analyze potential investments and use leverage responsibly. Depreciable real estate falls into 2 main categories: 27.5-year and 39-year property. The category your investment falls into determines how quickly you can depreciate the asset and claim those deductions on your taxes. Choosing the right type of property can have a significant impact on your overall tax strategy. 27.5-year property, as the name suggests, allows you to depreciate the asset over 27.5 years. This accelerated depreciation schedule provides a faster rate of deductions compared to 39-year property. This means you can offset a larger portion of your income in the early years of ownership, potentially saving you a substantial amount in taxes. This accelerated depreciation makes 27.5-year properties particularly attractive for investors seeking to maximize their tax benefits. However, not all real estate falls under this category. It's crucial to understand the difference and select investments that align with your overall financial goals. Section 4. Prime candidates for DSTs, hospitality, multifamily, and senior living. Certain types of properties are particularly well suited for DST investments due to their potential for accelerated depreciation and inflation resistance. Hospitality, multifamily, and senior living properties stand out as strong contenders in this regard. These property types often have shorter-term leases, leading to more frequent opportunities to adjust rental rates and keep pace with inflation. Additionally, they typically involve a higher percentage of personal property, such as furniture, fixtures, and equipment. This personal property can be depreciated at a faster rate than the building itself, further enhancing your tax benefits. Cost segregation studies can be particularly valuable for these property types. These studies identify and classify all depreciable assets within a property, ensuring you are maximizing your deductions. By taking advantage of these strategies, you can create a DST portfolio that is both tax efficient and resilient to inflation. Section 5. The drawbacks of long-term industrial leases in a DST portfolio. While industrial properties can be attractive for their stability, their long-term leases can present a challenge in a DST portfolio, especially in inflationary environments. When inflation rises, operating expenses increase, but long-term leases may not allow for corresponding rent increases. This can squeeze profit margins and limit your ability to keep pace with inflation. For example, imagine an industrial property with a 10-year lease signed before a period of high inflation. The property owner is locked into the agreed-upon rent, even as operating costs surge due to rising energy prices, property taxes, and maintenance expenses. This can significantly impact the property's cash flow and overall returns. Furthermore, industrial properties typically have a lower percentage of depreciable personal property compared to hospitality, multifamily, or senior living assets. This means fewer opportunities for accelerated depreciation and potentially higher tax liabilities. While industrial properties can still be viable investments, it's crucial to carefully consider their limitations in the context of a DST portfolio. Section 6. Building a resilient and tax-advantaged future. Creating a DST portfolio that maximizes tax advantages and withstands economic fluctuations requires careful planning and a strategic selection of assets. By prioritizing 27.5-year depreciable real estate, leveraging cost segregation studies, and focusing on property types with shorter-term leases and inflation-resistant characteristics, you can position yourself for long-term financial success. Remember, a well-structured DST portfolio should not only generate passive income, but also provide significant tax shelter. By harnessing the power of passive losses, depreciation, and strategic asset allocation, you can build a resilient financial future that weathers economic storms and preserves your wealth for generations to come. It's essential to consult with experienced professionals, such as a qualified DST sponsor, CPA, and attorney, to ensure your investments align with your individual circumstances and financial goals. With the right team and a strategic approach, you can unlock the full potential of DSTs and secure your financial future.